better panel to have this conversation with because, let's admit it, there's been a lot of doom and gloom headlines surrounding commercial real estate. I think it's fair to say a lot of negative sentiment of late, especially in light of the recent regional banking crisis. Even this week, Bank of America's Global Fund Manager Survey showed that most fund managers see commercial real estate as, quote, the most likely source of a systemic credit event. So for the panel, from where you all sit, where are we today, and what are the key nuances and realities of the current commercial real estate market that have been overlooked, and how can we better understand what is actually happening? Margaret, let's start with you.
Sure. I love that you said nuance. We were actually just joking a few minutes ago that sometimes these panels are interesting when we talk about global real estate and what's happening as a 30-minute topic, because obviously there's a lot going on depending on sort of the asset class, the region. So maybe just to pick apart the generalizing for just a bit, there are parts of real estate that are doing just fine, right? So I think we're going to unpack some of the major food groups, but clearly there are issues in office. I think anyone who says they know exactly where we're going to be a year from now, 5 years from now, is probably lying, but clearly there are issues with Class B and C. We all know that. Here, just in New York City as an example, vacancy in office is still, even with a lot of improvement, double where it was pre-COVID. But maybe just to go to the other end, multifamily, there are a lot of strong signs, especially if you're focused on some of the more resilient and stable parts of the market, like workforce and affordable. We actually see really incredible tailwinds there. And then rates matter. I don't think we've even begun to see the full impact of the increase in rates. It's obviously just really tamped down on transaction activity, as folks have to really agree where our prices, and buyers and sellers certainly don't agree. And I think that will continue to be an issue for years to come as we continue to see all of the existing commercial financing that's out there refi over the next few years.
Jeff, do you want to weigh in on the nuances and the realities of the market?
So I agree. I think there are lots of different parts of the real estate market that are performing very well right now, whether it's multifamily or hotels or newer office buildings, like we developed at Hudson Yards. Those buildings we call them Class AA buildings, and are really performing extraordinarily well. Certainly compared to the older buildings, the B buildings that you hear about. And I think what happens in the paper is we do get painted real estate with a broad brush of troubles that might sit in the regional banking system. And the banks will have some troubled loans on those older office buildings, but I don't think it's a systemic issue as much as has been written about. And so I still think there's a lot of opportunity. As Margaret said, the biggest challenge today is really interest rates. And it's very hard to value real estate today. It's very hard to finance real estate today. And so you're not going to see a lot of transactions happening. Buyers and sellers are apart, which is what typically happens when cap rates are moving around or valuations are moving around. So it's an interesting time in real estate. I think there's a lot of opportunities to invest if you're able to provide capital where banks are not. So there's opportunities if you have private credit into real estate, I think is an area that's very strong right now. We have a couple funds that do that. And so what we're seeing is a lot of borrowers that now are facing refinancing shortfalls. And so they'll have, let's say, $100 million mortgage. The new mortgage can only be 80. And so we'll come in and provide $20 million of capital, and we'll get paid, a significant premium to what we would have gotten paid last year for making the same loan. So there are opportunities. You have to work hard to find them.
Do you want to add anything, Nadeem?
Well, I mean, I agree completely with this idea that both Margaret and Jeff described, which is that there is this massive bifurcation today, greater than, frankly, we've ever seen. And I think the mistake people make is describing real estate exactly as Margaret said, as if it's one asset class. The reality is that historically it sort of was one asset class. If you go back to prior cycles, what would happen is there'd be a run-up in commercial real estate, whether you owned a regional mall or an office building or a warehouse or an apartment building. Rents would grow as the economy grew, Then the developers would come out, they'd start building, you might have excessive leverage, the cycle would end, and then it would start again. And you could make money in pretty much any asset class if you bought at the right time and if you own the right asset. I think this cycle, especially over the last decade, has been a little bit different because technology has evolved, demographics have changed, the way people live, work, and play has evolved, and that's resulted in this sort of dispersion across sectors for the same reason that warehouses, which are our biggest global theme, benefit from e-commerce penetration rising, is for the exact same reason that regional malls have been negatively impacted. It's this change in the way people shop. The same thing with the way people work. Think about the impact of remote work. Think about how people think about the office today. So our job, I think, as investors, for all of us up here, is to be able to understand the difference between the winners and losers, to see that nuance and then invest around it. And if you think that way, then I think you could look at today's environment, frankly, as being super interesting, because there are sectors today where we do still see, despite all of the headlines, historically strong supply-demand fundamentals.
You were mentioning just the changing nature of work, and Jeff, I want to bring this up with you because I know you know offices better than probably anyone out there. And how has the changing nature of work, especially remote work, or even other trends like even recent layoffs, maybe folks even realizing maybe they don't need as much office space, how has that affected the demand for the commercial real estate space?
So I don't think there's one topic that's gotten more press in the real estate world than office space ever than the current environment. And people like to ask me all the time, so how's the office market? And as we've been saying, there's really no one answer to that because the office market, like other asset classes, are now so bifurcated. And so we're seeing the older buildings, the B buildings, that people really don't want to go back to them. Tenants aren't renewing leases, and you're going to see a lot of troubled assets in that category, and that's where you might see stress in the banking system around loans to these older buildings. Even the A buildings, the better buildings, are just struggling a little bit as demand for space has declined. But what we are seeing, I can tell you this, and just to go directly to your question, if you were to take a survey of CEOs, a private survey, I would bet close to 90 to 100% of the answers saying they would prefer to have their employees full-time in the office. Now, they may not tell their employees that because they think they're going to piss them off and they won't be able to hire them, or they might go look for jobs elsewhere. But if you're asking them about productivity, they're going to say they want them in the office. And what we have seen is in the newer buildings, we actually call this class AA buildings. We've created a database of what percentage of the people that are in space that's leased actually coming to the office. So I could tell you, for example, at Hudson Yards, campus-wide, on a Tuesday, Wednesday, Thursday, where 80% of the people from the companies at Hudson Yards campus show up for work every one of those days. That's compared to somewhere between 46 and 50% for all of New York City on average. So if you think about that piece of data, why is that true? Because companies are realizing that they can use the office to attract people back to work. And so when CEOs can think about the office space as a talent attraction and retention tool, as opposed to occupancy cost, that incremental cost of rent is not that important. And so that's why you see also kind of lots of data, these new buildings outperforming the market. We're leasing space at $200 a foot at Hudson Yards. You can go 3 blocks away and lease space for $50 a foot, and there's plenty of it. So the question is why, and it's exactly that. I mean, people want all the attributes of a new building, but most importantly are recognizing that people will come back to the office in that type of environment. So I think it's a story of two tales again, of bifurcation, and we are really seeing the difference in the newer buildings.
Hey, you want
To
to
add,
sure.
I mean, I'm not going to say anything new, but just to throw an anecdote on that, we actually just recently leased, I don't know if I call it AA, but certainly high single A class office space in New York City, signed the lease a few months ago, and had that exact same experience, that for sort of even like really B+ office, there is unlimited amounts. You can have anything you want for 50, 55, 45 bucks a foot. But in the offerings for what we were looking for in terms of just light and air and open formats and some of the new sustainability features that I think people are caring about more and more, there actually weren't that many options. So it really is.
To that, so I just had lunch with probably the top broker in New York yesterday, and I was asking him how's it going, and it's just like everyone's asking, how's the office market? And he said, well, it's very difficult. He said, my job is harder than it's ever been because he represents a lot of private equity and hedge funds and opportunity funds, and they all come in so smart, and they're like, oh, the office market's terrible, so I want this great bargain. And it's his job to now say to them, well, that's true, but let me tell you where the bargains are. And when they say, well, no, I want this Class A office space with great views and windows and light and air and all that, he says, we don't have any space. And so it then becomes a race to find that last bit of space, and that's where you get these escalating prices. So the supply-demand fundamentals in that segment of the market are very, very strong.
Yeah. Well, you mentioned New York, so let me bring up New York City. And Margaret, I'll give this one to you because you are on the board of the New York City Economic Development Corporation. And you all probably remember, and this is for the panel as well, the 2020 op-ed in the New York Post, New York City is dead forever. So where are we in the recovery? Are we back? And what is needed?
Yeah, people who bet against New York, I question their intellect. But I'll share some actual data. And yes, I chair the board of EDC, so private sector hat off for a second. I'm a consistent cheerleader for the city, and I think the data actually very recently has been pretty encouraging. So one, just on private sector employment, if you compare where we are to where we were, we always look at February 2020, kind of pre-COVID, we're 99.7% the way there. So, 11,000 more jobs and we'll be right back where we were. Some things that are even better pre-COVID, we look at visa data on sort of just domestic spending in New York City, it's 110% of where we were pre-COVID. When we think about our just sort of neighborhood kind of Main Street restaurants in Queens and Brooklyn, Staten Island, pretty much every single place but just the core sort of Midtown and downtown Manhattan are more busy than they ever were. We look at, just as measures of tourism, we look at Broadway. Broadway's 87% of where we were pre-COVID. Times Square pedestrian activity is also around that 85% mark. So there's from an activity perspective, an employment perspective, New York City is roaring back. We're not all the way there, but it's in reach, I would say.
Y'all want to add anything?
I'll let Jeff comment because he is the biggest and highest quality developer in the city. But I guess my perspective on New York is just over our 30+ years of investing in commercial real estate. The one thing we've learned is not to bet against New York City for a lot of the reasons that Margaret mentioned. The arts, the culture, the talent, and the energy of this city. And so we own real estate in New York. And by the way, you can own more than just office buildings in New York, even though the skyline is full of beautiful office buildings. And we find that in our rental housing assets in New York City, whether it's 8 Spruce downtown or Stuyvesant Town, demand is stronger than it was before the pandemic. And you see it in the fundamentals, you see it in occupancy, you see it in rent. So the data on the ground would say, and I think we feel it as people who live in New York City, that things feel pretty good.
I think one interesting anecdote, we speak to our tenants all the time and kind of ask them how their businesses are going and where they want to go. And I was with the head of one of the big tech companies who we do a lot of business with that's global. And I asked, well, so what's your thesis on back to the office and office space? And his main answer was, we are going to provide flexibility. We're going to require people in the office, but we're going to provide flexibility as to where they can work. And that means globally. So if you have this job, you can say, what office do you want to work in? And it might be in London or wherever. And they did a survey of their, tens of the hundreds, thousands of employees. And the number one location that people wanted to be was New York City. And so as a result, they're actually short 700 desks in New York, even though globally they're cutting jobs, doing layoffs. And so, again, I think never bet against New York. It's definitely coming back. I think we've got a good mayor now that's supporting the city. And I think the demise of cities, to the extent that people talk about it, is almost always tied to some type of politics that are going on. And so you talk about San Francisco, and you look at what's happening on the street, and it's just, there has to be a balance of different rights of different people that ultimately will let cities work. Because if it goes too far to the right or to the left, cities won't function. People don't want to be in a city where people are doing drugs on the street, that they don't feel safe. Safety and security is the #1 thing that people care about in a city. And when people kind of value the rights of the people that are causing the crimes instead of the people that are otherwise in the city, that balance gets out of whack and the cities become non-functional. And so I think here in New York, sometimes we go too far in one direction. I think we're approaching the middle once again, and I'm very confident about the future here.
I was listening to you, Nadeem, and you're talking earlier about how commercial real estate often gets painted with a broad brush, and this will be for the panel as well, but Nadeem, let's start with you. How do you weigh the risks and the rewards of different types of commercial real estate, whether it's retail, industrial, multifamily, office, et cetera? And let's go over who are the winners in your mind, and also who are the losers? I know we talked about winners and losers, but in this macro environment.
Yeah, it's an important question. I mean, when you look at our portfolio and the way we invest and the way we have been investing for a number of years, it really is about sort of a narrow focus on a small handful of themes where we have super high conviction, where we see really good supply demand. Our global business today consists of around $600 billion of real estate assets, 83% of which is only in 5 places. In warehouses, our biggest sector, which benefit from these e-commerce tailwinds, now the onshoring of manufacturing. In rental housing, which is experiencing a shortage, frankly, across the country. That's something I'm sure Margaret has a view on, and also benefits from a demographic shift to the Sun Belt, which is a place we've been especially active. Also in life science office, which is benefiting from growth in biotech R&D. That happens inside lab office buildings. Also in hotels, we are big believers in global travel, in the growth of global travel over time. And then finally, in data centers, which are benefiting from this massive tailwind in artificial intelligence, in the cloud. And our experience has been that if you invest with tailwinds behind you, it's just a lot easier. One of the things that we've been more cautious about is office in the US, particularly commodity office. If you look at our business in 2007, 60% of our portfolio was in US office. If you translate that to today, less than 2% of our global portfolio is US office. So the idea for us is about trying to identify these trends and invest around them, but also use that same insight to be cautious in certain places. Another example of a place that's been negatively impacted, which I referred to earlier, is the regional mall business. We haven't bought a regional mall in the US since 2011. In fact, my first deal at Blackstone was buying 2 malls. And I thought I'd done this amazing deal in 2010, very high cap rate, cheap price, and it was not the best deal ever done at Blackstone. And so we learned from that mistake, actually, and we were much more cautious on the space. So you got to try to take the information in real time. The world is changing, it's evolving. Again, the idea of treating commercial real estate as if it's one asset class is a huge mistake. I mean, we keep talking about office. Office represents 15% of a $21 trillion asset class in the United States. So there's another 85% that we could be talking about.
Do either one of you all want to jump in, winners and losers?
Yeah, I mean, also not to be annoying on the whole nuance part, but even on the winners and losers question, it's sort of like, well, what's your time frame? So I think for folks who have a really high risk appetite and high conviction, clearly there will be interesting fallouts from office and that bifurcation, and that's a maybe shorter term strategy for some interesting opportunistic returns, but they're going to be high risk. I think for and most of my career and currently focused on sort of longer term, stickier trends. And I love residential in the US, especially, and I mentioned this briefly earlier, at the lower end of the segment, because the sort of main thesis that we think about is the 7 million unit shortage of units for kind of low, moderate, and middle income Americans, and whether we're in a pretty nice kind of growing environment or sort of more contraction that we're seeing today, that fundamental supply and demand imbalance, unfortunately for our society, doesn't budge much. And so I think the macro environment now is incredible for affordable and workforce housing, but I also thought that 5 years ago, and I will probably still think that 5 years from now.
Can I just make one point on housing? Because I think this is also another area that's maybe misunderstood, is that there's the undersupply, the shortage of housing that Margaret mentioned, which has been one of the most important drivers of the supply-demand fundamentals we see in the space today. But also with all this volatility that we're seeing in the market, with higher interest rates, with construction financing being more difficult, what we've seen is a decline in permits over the last 6 months, which aggregately in the US have fallen by 20%. So the very thing that was driving what I think of as sort of outsized above inflation rent growth in housing, which was an undersupply, in some ways has been exacerbated by this environment. So when you think about real estate and all the individual asset classes, it's about demand, but it's also about supply.
Just thinking about winners and losers, in addition to everything that was said, I think the other thing right now is cost of capital. And so, the winners and losers are really very much determined by capital stacks right now. So those that are highly leveraged or that have variable rate debt on almost any asset class are not doing well right now. And, those that have lots of capital behind them and not that much debt in the system are able to kind of get through this period. Interest rates will come back down. And so I think it's just some people are not able to hang on because of that increase in debt costs. In our portfolio, we have probably 3/4 of our debt is either fixed or has swaps or caps of some sort for the next couple of years. And so, we were fortunate, and not because we were so smart, but a couple of years ago when interest rates were 2%, you kind of say, well, it can't get much better than this. And so we were able to do that. We're also long-term holders, so we're able to take a longer view and lock rates. Sometimes in a fund format, you can't really do that because then it prevents your flexibility to exit and sell. But on the other hand, you could put a lot of equity into deals. So I think this is a time for a well-capitalized investor to stand out far above others.
Can I get one more winner? And this is more, I think, a point that you were actually making earlier, Jeff, but also in the winners and losers, separate and apart from asset class, I think there's just quality is always a winner. I don't think we talk enough about just overall pure obsolescence risk. So we talk about sort of not nice office or, older housing and how it's not sustainable, but I don't think that we think as much about housing, I'm sure warehouse assets that don't have, I'm not a warehouse person, but whatever sort of technical innovations have been productive over the last several years. So I think regardless of what asset class you're in, I do think, assets overall that are being built now and over the last 5 years are just fundamentally different than what we built 20 years ago and 30 years ago. So
I think that's a
winner.
really, really important point also. I agree and what you see actually to that point is what happens is when rates are low or when the real estate cycle is sort of, several years in, investors sometimes make the mistake of not differentiating in terms of quality, because what happens is spreads start to compress, cap rates begin to compress, and the differentiation between the price or the yield on an apartment building in a high growth part of Austin is not that different than the cap rate for an apartment building in Rochester, New York. And those two cities are growing at different rates. And so I think what happens is sometimes people chase slightly lower quality or materially lower quality for just a little bit of extra return on paper. And that can turn out to be a mistake when the world changes, as we're seeing it change now. So focusing on the highest growth markets, the highest quality assets is always really important at any point in the cycle.
That's a really good point. And also just maybe let's explore some trends too of like what do people want or what is working. I know like Hudson Yards, for example, is incredible. So maybe we can just talk about like from where you all sit, maybe it's the quality side of things, but just what do people want?
You know, one of the things that we've pushed is how do we stay away from commodity real estate? And so we're always trying to figure out how we call it, focusing on high margin businesses. And so, if you look at multifamily in general, you could say, in many cities, it's a very competitive asset class. And as a result, lots of capital flows in and returns get compressed, even though it's a strong growth market. And so, we've spent a lot of time trying to evolve our product and keep it differentiated. So, for example, at Hudson Yards, we just opened a new concept called the Set. And the Set is our new version of a multifamily product, which is really a mix between a hotel and residential living. And so it's essentially the units are slightly smaller, say 5% smaller, but they are fully furnished, highly efficient. When you walk in, they definitely don't feel smaller. And lots of services. So you can have daily housekeeping, you could have room service. We've got tons of amenity spaces, co-working, pool deck. In fact, when you sign a lease, you actually don't sign a lease, you become a member of the club. And everything's done with technology. So you can go to the pool deck and order a drink and put it on your account. You can type in through your app that you want your refrigerator stocked with food for the time you get home. And so this is a very kind of unique product that we're actually able to get a premium to probably the return on the physical real estate. That premium includes kind of the operating benefits, the execution capability that we bring to the table. And people love that type of living, and I think that's reflective of a real demographic. Interestingly, the demographic target was kind of millennials, super busy, working on Wall Street, want everything taken care of, immediate gratification, and that is still a big part of it. But this was designed pre-COVID, open post-COVID, and what we're seeing, an additional segment is people that are in New York only 3 days a week. They live in the suburbs somewhere, and they were staying in hotels. And if you think about the cost of a night in hotels, if they're staying 3 nights in a hotel, you can actually rent an apartment that has all the hotel services and amenities, and it's their apartment and leave their things there. So it's constant innovation. We've done that on the senior housing side with a product called 𝐻𝐢𝐬𝐿, which is a high-end senior housing product. And so I think you have to be on top of this game. If you think you're just going to buy the same product and do it again and not evolve, that's where I think you can get caught.
Well, we only have 2 minutes, so this will be for the panel. And we can go down the panel. We'll start with you, Margaret. Where are you either deploying capital, growing your footprint? What are the opportunities that are most exciting for you going forward?
Yeah. So residential. I would say one thing that I've been pretty excited about is just with where rates are. One of the things that's nice in the part of multi that we work in is that we still have a lot of activity and support from Freddie and Fannie, from the GSEs, who have actually been, incredibly active given just, the market and sort of some of the volatility out there. So within affordable and workforce, we really like an execution where we work with local municipalities to buy existing Class B housing that is naturally affordable. People call it workforce, people call it naturally occurring, and then where we can work with those municipalities to actually lower our property tax expenses pretty materially so that there's sort of a source of yield to then put a lot of work and CapEx into those housing developments, and then also maintain the affordability. So doing a lot of that around the country. More and more municipalities are signing up for it every day. So very, very excited about that.
I'd say we've expanded the markets in which we operate, historically large urban kind of core tier 1 markets, and now really chasing more what used to be tier 2, but now higher growth markets. Big shift into Florida, West Palm Beach and Miami, Austin, Texas. So that's a big move for us. And then the newer office, right? Again, for all the reasons we talked about, that's going to be an area of growth for us.
For us, I would say a lot of this at the moment is just doubling down on the same places we've been investing, where we have conviction. And I think the thing for all of us is that, investing at a moment like this is not like one of those things where there's an all clear sign and then suddenly it's like time to start investing. we're seeing opportunities. We have been for the last several months. We've deployed globally $4 billion into industrial assets since January. And the other place we've been really active is in the data center space. We've committed to several $1 billion of data center developments just in the last few months, and that's a space where I think we have more conviction and we see more growth than maybe anywhere in the real estate space. So and I think the pipeline over the course of the next few quarters will start to build. Naturally, in a moment of volatility, transaction volume tends to slow, but I think we'll see a pickup as we get through the next few quarters.
Well, Margaret, Jeff, and Nadeem, thank you all so much for being so generous with your time and your knowledge. Thank you all so much. Really appreciate you all being here.